Hello and welcome to another tutorial video. This time around, we're going to be talking about balancing your balance sheet and also Batman and how Batman relates to this problem of a balance sheet going out of balance. So we get a lot of panic questions about what to do when you're building a three-statement model and your balance sheet does not balance. Now, maybe I'm a strange person, but the first thing I always do is think about Batman, specifically the end of The Dark Knight. So I'll go to a clip right now and refresh your memory of what I'm referring to.
That's what I can be.
No, you can't. You're not.
I'm whatever Gotham needs me to be. Call it in.
A hero. Not the hero we deserved, but the hero we needed. Nothing less than a knight. Shining.
They'll hunt you. You'll hunt me. You'll condemn me. Set the dogs on me. Because that's what needs to happen.
So just like in the movie, with this problem, there's an answer you deserve and then an answer you need. Now, in an ideal case, you'll use the answer you deserve, the right way to fix the problem. But if it's 3 a.m., you're out of Red Bull, the coffee machine is now broken, you'll probably just have to go with the answer that you need. So the answer you deserve with this is that if your balance sheet does not balance, your model is too complex or it does not follow the best practices. Now, a while back, we had a whole video tutorial about the best practices for financial modeling in terms of formatting, model layout, and setup. And so I strongly recommend going back and looking at that. And if you have the time, going in and actually fixing or redoing your model to follow those standards. Because if your model is simple and streamlined enough, it should be pretty easy to make sure the balance sheet balances. Of course, if you don't have the time, or it's 3 a.m. and you just need to finish something and go home, then there is a process you can follow to go through the model line by line, step by step. I'm going to lay out the steps here. Then we will go to an Excel example, which I'll link to on one of the next screens, where the balance sheet is very clearly out of balance by a pretty substantial amount, and it doesn't really seem to follow a clear pattern or trend. So I will show you how to dissect something like this and follow the 4-step process here to fix it. Step 1 is to look at the discrepancy. So total assets minus liabilities and equity each year, and note any patterns. Even something small can sometimes be a clue or a hint as to what's going wrong. Step 2 is that you have to review each balance sheet line item and make sure the change in that item is reflected on the cash flow statement once, or that if it's not reflected on the cash flow statement directly, it is linking to the old balance sheet number and then the matching cash flow statement line items with the proper signs. So you should be subtracting them on the asset side and you should be adding them on the liabilities and equity side. Now, as you do this, you'll want to highlight in yellow the items on both financial statements, the balance sheet and the cash flow statement, that you have checked and confirmed. This will be important because you could run into collisions where you have referenced the same item twice. In other words, you've double counted something, and these highlights really help you track that down and prevent it. Now, in step 3, if you finish the entire balance sheet and you still haven't found the problem, then you'll want to move to the cash flow statement and focus on the non-zero unhighlighted line items, because they are the ones that are most likely to be creating this type of discrepancy. In fact, they're the only ones that should be able to create this if you have done everything else properly so far. You can also check the historical cash numbers and the net change in cash line items. We've seen in a lot of cases that students get these wrong or the historical data is wrong, and this explains in some cases why the balance sheet is off. And then finally, step 4, if you can't find the problem after all this, you have to go back to the answer you deserve and take the time to simplify and consolidate your model. And you'll find that in a lot of cases, if you do this, the problem either diminishes or it disappears completely, or it becomes much easier to figure out what's going wrong. It does take some time, but in my opinion, at a certain point, it's better just to do that than to spend hours and hours going over your entire model looking for a needle in a haystack. So if you want the written version, the images, and the broken and fixed Excel files, you can go to this URL on screen. It's on our 3-statement models knowledge base page, balance sheet not balancing. I'll link to this and pin it as the first comment below the video as well. So the outline for this tutorial is as follows. I'm going to walk you through each step of the process I just showed you with the Excel file that I've created here. So we'll review the discrepancies. We'll do a line-by-line balance sheet review. We will look at the cash flow statement after that. And then I will explain what to do in this case if nothing here works and what I would do with this specific Excel file if we were not able to find the problem. So let's go to step 1 and talk about the discrepancies. So there are a couple different categories. The easiest one is where the difference each year is constant. So it's maybe positive 10 or negative 10 each year. Usually this means that you just forgot to link an item in a single year, but then after that, it's correct or it's 0 or something like that. So usually this one is pretty easy to fix. If there is a variable difference, but it changes by a constant number, then usually this means that some formula is wrong, but it only happens in one period, such as year 1. And then the hardest case, the most common one, is where the difference is variable and it's also changing by a variable amount each year. And typically this means that at least one formula is wrong and it's wrong all the way across over the entire projected period. Let's go to our Excel file here and see what we can say. If we go down and take a look at this, the balance sheet is definitely balanced in the historical period, but then in the projected period, it's off by a variable difference. And if we look at the differences between these discrepancies, it doesn't really seem to be following a clear pattern or trend. It's off by about 8 or 9, and then it changes by about 13, and then 27, and then 20 or 17, and then 22. So we don't really see much of a clear pattern or trend here. What this is telling us is that it's probably not something very simple. It is probably something where an entire formula is wrong or missing or double counted or the sign is incorrect or multiple items are wrong and maybe one is simple but one is more complex. Now some people in this case would recommend creating a difference column where maybe they look at the difference between the cash in year 2 versus year 1 and they create this type of column and then they copy it all the way down and then they try to compare it to these balance checks at the bottom. We don't really recommend doing this because in our experience, usually it is more complex than that. Usually with something like this, it's not just one single line item that you forgot. It's something a bit more complicated, whether it's double counting or using the incorrect sign or multiple items are wrong or something like that. So let's go into step 2 now and do a line by line balance sheet review. We're going to skip any line items that stay constant each year, such as goodwill in many models. Now, the problem could be related to one of these items, but usually they're not direct causes simply because they're constant in each year. So looking at this model, we would say that the goodwill we definitely want to skip because it's constant each year. So I'm going to highlight this in yellow just because we don't think this is the cause of the problem if it's something like this. Deferred tax assets we're also going to highlight in yellow because it appears to be staying constant in the projected period. So this is less likely to be the cause of this issue, although something related to this could still factor in some way. Now with most of the other items, they do change and they are non-zero. Investments under non-current assets is actually 0, so we can also mark this off as yellow. We're not going to pay attention to it because it's 0 in every single year. And then going down, most of these other items appear to be changing, so there isn't really anything we can just cross off the list right here. Long-term debt is constant in a few periods, but it actually changes by the end, so we can't just ignore it. And then of course, equity changes each year, so there isn't really too much we can ignore on this side. Once you get to the items that actually change, you want to check that the change in the item is reflected on the cash flow statement with the correct sign. If it's not reflected on the cash flow statement with the correct sign, you want to see that it is linked to the old version on the balance sheet and then the matching cash flow statement lines with the correct signs. So on the asset side, with something like short-term investments, you want to be subtracting the corresponding cash flow statement line items because you're on the asset side of the balance sheet. So that's the type of thing you want to look for. Now, on the liabilities and equity side, for something like long-term debt, you want to be taking the old number in column G right here, and then you want to be adding the debt-related line items. You're adding them because you're on the liabilities and equity side of the balance sheet. So those are the types of things that you would want to look for here. Once you do this, you highlight any lines that appear to be correct. If something is not correct because you've forgotten it or the sign is wrong or something like that, then just make the fix and then highlight it after that. If you get a collision where you have found a link to an item that you've already highlighted, then you're double counting something, so you'd want to remove it in that case. So let's go to the balance sheet and start doing this line by line review. Now what I like to do here is use the control left bracket and control right bracket shortcuts on every single line to trace the dependents or to select the dependents and select the precedents to see what the line item is coming from and then what it is going to. So with cash, for example, if we press control left bracket, we can see that it is coming from the very bottom of the cash flow statement, which is correct. That's always where cash should come from. If I press enter, there's really nothing else that it links to there. So that is all it's coming from. It's only source. If I press Control right bracket, we can see that it is affecting the interest income and it's affecting the total current assets here. But if you press enter a few times to cycle through, those are the only things it's affecting. So we can conclude here that cash is correct because it is flowing in from the cash flow statement as it should, and it doesn't appear to be affecting anything else on the cash flow statement. So it's not being double counted. So I will go and highlight this in yellow. Now for short-term investments, let's do the same thing. Control left bracket first. I'll expand the grouping so we can see the old number as well. So it is coming from these two lines on the cash flow statement, sales and purchases of available for sale securities. If I cycle through, it doesn't seem to be coming from anything else. And then if I press Control right bracket to see where it's going to, it affects the next number, it affects interest income, and it affects other current assets, but nothing else. So we can conclude this is correct. It's pulling in cash flow statement line items. It is correctly subtracting them because we're on the asset side of the balance sheet, and it doesn't seem like it is affecting anything else on the cash flow statement. So it is not being double counted or using the incorrect sign or anything like that. So I'm highlighting these lines in yellow on the cash flow statement as well to show that they have affected something on the balance sheet now. So let's keep going. We get to these next four items: accounts receivable, inventory, prepaid expenses, and prepaid income taxes. And all these follow the same format, which is that they're all linked to a percentage and then an income statement line such as revenue or cost of sales or operating expenses. And you can look at all the formulas, but they all follow that format and they don't come from anywhere else. So the key question here is, are they properly reflected on the cash flow statement? And if you press Control right bracket and you press enter to cycle through, you can see that for accounts receivable, we are taking the old number and subtracting the new number, and then inventory, same idea. Prepaid expenses and other assets, same idea, although we have another item in there, which we will come back to in a little bit. And then prepaid income taxes, same idea. So for all of these, it seems like pressing Control right bracket on each one, they are being reflected once and only once on the cash flow statement. And they use the correct signs because we're taking the old item and subtracting the new item, which is what you should do for the change in assets. So I will highlight these in yellow, even though there is that question over this one, the prepaid expenses and other assets. I will also highlight these in yellow because we verified that they are being counted only once on the cash flow statement. Investments we're not going to look at because it is 0 in the projected period. And then for net PP&E, same idea. Control left bracket and Control right bracket. If you press Control left bracket, it is linking to the old number, and it is subtracting various line items on the cash flow statement. If you press enter to cycle through this, you can see all the lines here. We have a couple of CapEx and acquisition lines, and then we have some gains and losses and D&A on the cash flow statement and cash flow from operations. And then if you press Control right bracket, it's affecting the next net PP&E number and total non-current assets, but it's not flowing into anything else on the cash flow statement. So I'm going to mark this line as complete. We'll do that right now. And then let's go down and mark off what we found down here. So depreciation and amortization, that definitely affects the PP&E, and then the gains and losses here also affect it. And let's go back. I forgot what else links into it actually. So Control left bracket, let's go down. Okay, so the gains and losses, and then the impairment of property and equipment, this also affects it. And then we have a couple of line items down here, the acquisitions, the proceeds from the sale of PP&E, and then the CapEx. So all these flow in, and so I'm highlighting them in yellow. If we run into a case where something else references one of these items, that means we have a collision. We're double counting an item, and so we need to fix it. So that's why I'm highlighting them in yellow for our reference so that we know they've already been factored in. Let's keep going. So other intangible assets, same idea. Control left bracket and Control right bracket. Control left bracket, it's the old number, and then we're subtracting the impairment line on the cash flow statement, and then the additions to intangibles. So we have these two, and nothing else seems to affect it. If I press Control right bracket, it affects the next line item and total non-current assets, but nothing else, nothing on the cash flow statement. So I can mark this one as complete. And then let's mark our impairment here because this flows in. And then our additions to intangibles here, I'll also highlight in yellow because this flows in. So there's one line item here left, other long-term assets. I'll press Control left bracket. We're linking to the old item, and then we are subtracting the decrease or increase in other assets. And then we're also factoring in the non-cash lease expense here. So we have that. Now if I press Control right bracket, it affects the next year's number. It affects total non-current assets. But if you press enter a few times to cycle through, it also affects prepaid expenses and other assets on the cash flow statement. So we have a collision here. We are double counting this item because here we are saying that it flows in from the cash flow statement, but we're also reflecting the change in this item on the cash flow statement. So we are effectively double counting the change in this item on the cash flow statement, which is one of the major mistakes in this model. The easiest way to fix this is to go to prepaid expenses and other assets and simply delete the reference to row 111 here for other long-term assets so that now we are just referencing prepaid expenses and other assets and not other long-term assets. Once you have that, copy it across with Alt-ESF or Control-R, and so we have fixed that. One thing I now want to do as well is highlight the decrease or increase in other assets because this is being correctly linked to a single item on the balance sheet. We can also highlight the non-cash lease expense right here, and we have that. And then our other long-term assets, this is now correct because now we are not double counting this anymore. So I'm going to mark this off as correct. And so we have that. So we're done with the asset side. Let's move to the liabilities and equity side. Now, the first few line items here are working capital line items, and they all follow the same basic pattern where if you press Control left bracket, they're linked to a percentage and then an income statement line item like cost of sales or operating expenses. I'm not going to press Control left bracket on every single one of these. I think you get the idea. If you press Control right bracket, you can see that they're all reflected in the change in working capital section down here. And you can do this repeatedly for each of them if you want to save some time in this video. I'm not going to go through every single one of them, but if you cycle through them, you'll see that they're all reflected once and only once on the cash flow statement. So going down here and just looking at all these formulas, these all seem to be correct. Now the deferred revenue one is a little bit concerning at first because it seems to be linking to two line items, but that's just because we have short-term deferred revenue and long-term deferred revenue. And in both cases, we're taking the new number and we're subtracting the old number, which is what you should do when you are reflecting the change in a liability on the cash flow statement. So these all seem to be correct. Just to save some time here, I'm going to highlight these and I'm not going to go through this whole part step by step, but if you want to, you could certainly do that. And then I will highlight all these items because we've looked at them, we've looked at the source, we've looked at what they link into, and they all seem to be fine. Other liabilities actually follows the same format as well. If you go up, it's just a percent of the operating expenses. And then if you press Control right bracket, it's also linked to down here. So this one is also fine. And then for long-term debt, so here, if we press Control left bracket, it's the old number, and then we're adding some debt-related line items down here, payments and borrowings on debt facilities. And then if you cycle back to the top, that's really all we're linking to. If you press Control right bracket, it does affect the interest expense as expected, and it affects the next line item here and the total non-current liabilities, but it doesn't affect anything else on the cash flow statement. So it looks like this is correct because we're on the liabilities and equity side, we're taking the old number and then we're adding cash flow statement line items. This is what you should be doing when you're linking to items on the cash flow statement from the liabilities and equity side of the balance sheet. So I'll highlight this and then we'll go down here and then we will highlight these debt-related line items that linked in. So let's keep going. And we'll go down next to total equity because the total liabilities here are just summations and they're not linking to anything on the cash flow statement. So for total equity, we have quite a few line items that link in. We are starting with the old line item and then pulling in various lines from the cash flow statement. So we are starting with the old item. We're correctly adding them because we're on the liabilities and equity side, so that seems fine. If we press Control right bracket, equity affects the next equity line and total liabilities and equity, but it doesn't show up on the cash flow statement, so we're not double counting anything there. So let's go in and just press Control left bracket and go through these. Net income, stock-based compensation, issuances of common stock, stock repurchases, and FX rate effects. So all that looks fine. Let's highlight these in yellow. Stock-based compensation, and then issuances and repurchases of common stock, and then FX rate effects down here. And so we have that. So we're now done with the balance sheet, but as you can see, it still doesn't balance. Our balance sheet is still out of balance by a pretty good amount, about 18 million, 38 or 39 million, 61 million, 87 million. So we still have an out of balance balance sheet, which means that we need to go to the next step in this process. So going to step 3 here, we now need to look at the unconfirmed cash flow statement lines and in general, do a bit of a review of the cash flow statement. So you want to focus on anything that has not been highlighted that is non-zero and use the control right bracket shortcut to make sure that it's not actually linking to anything on the balance sheet. Then either fix the cash flow statement line item and make it flow into the most relevant balance sheet line, or if you don't know where it goes, just make it flow into equity. You also want to check the ending cash number on the historical cash flow statements and compare it to the balance sheet number, and check the net change in cash calculations. We've seen a lot of students make mistakes or start working with incorrect historical data, and that sometimes causes the balance sheet to go out of balance as well. So let's go down and do just that. So looking at this very quickly, there's really only one item on here that has not been highlighted, which is deferred income taxes. So this immediately stands out. And if you look at the numbers here numerically, it seems like this is very close to the discrepancy in the first year, 18.1 million versus 18.2 million right here. So this could very easily be our issue. And if you just go down and press control right bracket right here, it affects cash flow from operations, but it doesn't appear to flow into anything on the balance sheet, which is a problem. So the easiest way to fix this is to go up to deferred tax assets. We're on the asset side, so we're going to subtract this line item on the cash flow statement. I'll do that right now and then copy this across. And we have that. And this gets a lot smaller over time. And we can mark off deferred income taxes because this has now been correctly reflected on the balance sheet. So we have everything here highlighted. We have everything in the balance sheet highlighted, but the balance sheet is still not balancing properly. It's still off by about 0.15 million in each period, 0.148 million exactly. It's a constant difference. And this typically means that a single line item somewhere is off. We've forgotten something or we're using the correct number in one period, but after that it's zero or the difference doesn't persist. So the first thing I would probably do here is look at the net change in cash and just make sure that this is correct. So the change in cash and cash equivalents, cash flow from operations, investing, financing, and FX rate effects. A lot of people forget to include the FX rate effects, which sometimes causes these issues. Although in this case, that's probably not it because it's just a simple constant difference. The next thing I would probably do is look at the ending cash numbers here and compare them to the ending cash on the balance sheet. So let's go up and link in the cash from the balance sheet. And so we can see that by looking at this, it's pretty obvious what the problem is, which is that there is a very slight discrepancy here between the balance sheet numbers and the numbers at the bottom of the cash flow statement for whatever reason. We don't know why. Sometimes companies use inconsistent numbers and the historicals are off for some reason, but that seems to be what's happening here. So the easiest way to fix this is to go back to the original hard-coded number in the first historical year. Look at our discrepancy right here of about 0.148. I'm going to do a copy and paste as values, Alt ESV. And then we can take this number and then we can simply go into our beginning cash number here and we want to subtract this. And now our cash numbers, at least the cash number in the most recent historical year, should match up. And if you go to the balance sheet, now this balances properly. So this is a very, very common issue. We've probably seen dozens of cases where someone is just working off of incorrect historical data because of the company being inconsistent or rounding errors or various other things like that. And that's what causes this type of thing. I'll do a copy and paste values on this beginning cash because we don't really want to leave it in that state. And then I'll delete these links at the bottom. And now our balance sheet balances. Now this is still not a good model. It's overly complicated. It is confusing. It has too many different line items. And so I would strongly recommend simplifying and consolidating it. But if you don't have time, it's okay. And this gets you a fix in about 15 or 20 minutes rather than having to spend more time than that redoing the entire model. Now, if none of that worked, if you followed this entire process and your balance sheet still doesn't balance, I would go back into Batman mode here, and I would actually then simplify and consolidate your model according to best practices, reduce the line items on each side to 5 if you can, maybe a little bit more, reduce the cash flow statement, don't list every single working capital line item separately. The problems often disappear or become a lot easier to resolve when your model is much simpler to begin with. So let's do a quick recap and summary now. In this process of fixing your balance sheet, you always want to start by reviewing the discrepancies and seeing if there's any pattern between why the asset side and the liabilities and equity side do not match, because it can often clue you in as to the problem, whether it's simple or more complex. Then you want to do a line-by-line balance sheet review, as we did here, and press Control left bracket and Control right bracket on each item. Look at where it's coming from and where it's going to. Make sure nothing is double counted. Make sure the signs are correct. Make sure that you are linking to the item in one and only one spot on the other statement. Once you've done that, and if there are still problems or if you haven't found the problem, then you go down and you look at anything on the cash flow statement that you have not highlighted in your review, and that should clue you in as to the problem. You can also look at the historical cash numbers. That often explains it. Sometimes the net change in cash calculation can also explain it. And if none of that works, just try simplifying and consolidating your model a bit more, and oftentimes you will find it easier to fix the problems after you've done that. So that's it for our lesson. Hopefully now you have a better sense of what to do when your balance sheet does not balance in a 3-statement model, and how you can spend some time doing a review to fix the problems.